Jeff, fantastic to get you on Real Vision.
Well, it's nice to be here. Thanks for inviting me.
Yeah, not at all. It's good to have somebody, who lives and breathes the bond market. So this is going to be fun. Let's go back a bit in time and just talk about your career. How did you get to where you are today? And what are you doing now, essentially?
I grew up in Canada, born and raised in Canada. And as a kid, I always loved markets. I always was trying to invest money and money I never had as a kid. So it was always sort of something I wanted to do. I went to university, a couple of university degrees. And then I got my first sort of job working for the government of Canada in the Department of Finance, which I thought would be amazing. I did find out, and I'll be honest with you, I'm a pretty terrible bureaucrat. So I think I might have been the first government employee to almost be fired. It was impressive. So then I went back and I worked in the private sector, and I worked for a rating agency in Toronto. And then I came to Fidelity in 1995 in fixed income, and I've been there ever since.
Everybody I know from Fidelity has been there forever. Nobody ever leaves.
Well, you know what? It's a great community. I will say, we have an amazing team. Like I am so blessed because, I work in Merrimack, New Hampshire. That's where our bond division is. We moved up here in 1997, and we moved up here because we wanted to have our own culture. You remember in the 1990s in Fidelity in Boston, you had Peter Lynch, one up on Wall Street, rumbling around. And he is an amazing investor and a beautiful human, but he was big, and we just couldn't find our spot. We're bond investors. We're trying to get people back their money, right? So we moved to Merrimack, New Hampshire, which is an hour north of Boston, and we built a purpose-built trading floor designed for communication, for real teamwork. So we didn't want a star system. We didn't want a committee. Teamwork, and everyone's job is valued, and the people we have are, in my mind, experts in their field. And my job, as much as anything else as a portfolio manager, is to work really closely and listen closely to my team.
So talk me through your career at Fidelity a bit. So you turn up at Fidelity in the 90s. What's your career path as you go through?
So I showed up in 1995, and it was just on the back end of the Mexican peso crisis. So there was a lot going on in bond markets, and clients around the world have been nicked by that. But not only the Mexican peso crisis. Remember, Chair Greenspan at that time had raised rates and then lowered rates. So that was the backdrop to when I showed up. And so there was a lot of moving parts, even within Fidelity. We were trying to reassess and think, how are we going to best run fixed income for the next 30 years?
Yeah, and we'd just gone through 1994 as well, which was quite a big year for the bond market.
Yes, it was. Well said. And so 1995, I show up as an analyst, and my sectors are banks, energy, and real estate. Talk about eclectic, right? And the banks, though, were what we called Yankee banks, which were non-U.S. banks, so global banks, Intesa, that kind of stuff.
Dollar-denominated debt.
Mostly dollar-denominated, yes. In fact, the focus was just dollar-denominated. At the start, it wasn't, but it became very quickly dollar-denominated. Yeah, so I was an analyst. I worked as an analyst for 5 years, and then I got tapped on the shoulder to become a portfolio manager. And my first portfolios I started running were for Canada. I ran our Canadian dollar portfolios. And in fact, I still have a big hand in our Canadian dollar portfolios. I've never let them go, sort of like pretty near and dear to my heart. And then in 2002, a really great time in the market with Enron and WorldCom. If you remember, we were on the back end of Y2K, long-term capital in 1999, the Fed raising rates 6 times in 2000. 2002 comes along, and I get to take over a lot of U.S. dollar portfolios. And the rest is sort of history. It's been an amazing run.
And what's your role now?
Still portfolio manager. I still have a number of portfolios. I really follow a lot more multi-sector now. So I was more core bonds before. Now they've expanded my sort of scope, if you like, to be more things like I can buy high yield, I can buy loans, emerging markets, we can buy non-dollar, hedge or non-hedge. So it's a bit bigger scope. And one of the great things that, when you think about a career in retrospect, and I'm older now, when I showed up, we didn't have a lot of assets under management in bonds. We were really an equity shop. Now we're $1 trillion, and it feels amazing. have been part of this whole process the whole way along.
Fantastic.
Yeah.
So let's talk, you're a bond guy, so let's talk macro. This is a very complicated world out here because we've got a lot of inflation. Growth looks like it's slowing fast. You know, we've had, well, the largest rate of change almost ever in yield, in percentage terms of bond yields. All of this, what is your macro view? And then we'll dig into bonds.
Well, you're absolutely right. Year to date, this is the biggest drawdown in the bond market we've seen forever. This is bigger than 1994. We already hit on that. That was a big one too. This is bigger. In fact, this is the biggest drawdown in the aggregate bond benchmark since like 1980. So you think about the ag benchmark starting in the late 1970s, you get a sense that this is number one. This has been a big bond market drawdown. And I say as a macro, you know, if you think about the way we think about the world, we always think, you know, in terms of our bond market top down. So I know when you think of Fidelity, you often think bottoms up. Our equity team, high yield, a lot of bottoms up picking. Our bond team starts top down. Okay, so I'm thinking top down to start and level set. And with macro, what we're always looking at is how much money can we make for clients. So you start with the yield. How much yield is there around in the world? And then what are the things that are going to either enhance that yield or take away that yield? So price discussion. And so the macro story we have today is we have a Federal Reserve that feels like it's late. Whether or not you believe they're late or not, they believe they're late. And so they've been moving fairly aggressively of late. And the bond market, when the Fed is raising rates, is no longer a diversifier of stocks, right? It's a diversifier of stocks when the crisis is happening in stocks. But when the crisis is bond-driven, it's not a diversifier of anything. It's now just selling off because the Fed says we're late. And not just the Fed, even the ECB seems to be changing. President Lagarde, she's starting to talk about, you know, changing a little bit. Governor Kuroda in Japan, he's on the hot seat. He's the one trying to hold 25 basis points for 10-year JGBs. We'll see how that goes. So our macro piece here is that we have more rate fall, kind of rate fall back to the 1990s, right? That's where our head is. We've got used to interest rate repression, spread repression. We've had the big Fed there, always the Fed put in our back pocket since Chair Greenspan. This is a group, because they're behind in the Fed, that's going to have to suck it up and allow the market to be a little less efficient, a little bit more volatile, and have a little less price transparency.
So the yield curve inverted earlier this year. What do you read into that?
So short-term inversions, I don't read a lot into it. So when the Fed starts getting going, they'll yank the curve and they should pull it up. And eventually, if they yank too much, they'll invert it. So I don't read a lot into the inversion we had in the second half of 2021. In a lot of ways, by the way, we if you remember, in February 2021, we had a really steep yield curve. It was like a ski slope. And so then it had to rally. And we actually were long duration for that whole period because the ski slopes mean that you're rolling to lower and lower yields if you wait with bonds. And so bonds prices are going up just by waiting. So that can't happen when the Fed's in action. So as that ski slope went away, then the Fed started rumbling that we may be doing something on the short end here, raising rates. And then when the pivot happened, we were off to the races. So far, the bond market yield curve is not saying 100% recession, but it's certainly in the category that is telling you that won't take much to push us towards recession.
Yeah, and I look at a lot of forward-looking economic data, stuff like orders, new inventories of ISM, stuff like that. All of the forward-looking stuff is coming down fast.
Yes.
That suggests that growth is going to slow. It's not clear that there's a recession baked in, but it feels that the bond market did the tightening for the Fed.
Yes.
And that the Fed is kind of irrelevant at this point because the bond market did it all.
Oh, in fact, I think that was on purpose by Chair Powell. So think about what happened. Last summer, Chair Powell is listening to his economists. He's got his own forecast, and he keeps saying it's transitory in terms of inflation. At some point in the third quarter of last year, Chair Powell has an epiphany. I don't think this is transitory. And I think my economists are a little off base, or their lag time is going to be years out. So I have to pivot here. So the first thing he does, if you remember, goes to the Senate and the Congress and says we're not using transitory anymore. And then in October, he truly pivots, said we got to raise rates. Well, when he does that pivot, think about this. He doesn't have a rate path because his economists are saying things were fine. So he has to immediately adopt a rate path. So for want of a better rate path, he just says, well, there's the market. I'm just going to adopt what the market has. And that fits Chair Powell. Remember, Chair Powell's not an economist. He's a lawyer by training. He's more of a private equity, listen to the markets kind of person. So his natural state is the markets. And so it was probably really hard on him to just listen to economists last year. So you think what he's done is he's just adopted the rate path of the market. So why doesn't this feel violent? Because he just said, I need a rate path, I'm taking yours. And that was it. And so he's taken 50 because that's what the market offers. Next month, if the market's got 50, he'll take it again, right? And so those are kind of in price. What's not in price right now is QE to QT, that big fat pipe that's repressed interest rates, that's repressed mortgages, treasuries, inflation-protected bonds. The Fed owns, 30% of inflation-protected bonds and mortgages? 30%. That's a big market. And they're going to take their balance sheet from $9 trillion to $6 trillion. That's not in price. But the rate path, that is exactly what you're exactly right. The market's done the work for him, and he's just adopted it.
So I guess the question is has the market overshot yet? Has it already baked in its slowdown? And therefore, does he ever get to what the market is pricing now? I mean, do we get to the 350 basis points or whatever the market thinks, or are we going to see the bond yield starting to rally?
So here's what I think. So you've heard this notion of R-star, right? What's the neutral rate? I don't think he knows. So he's kind of a little bit like a bad doctor right now. He doesn't really know. So he keeps squeezing us. Does that hurt? Does that really hurt? How about that? And so for him to define neutral, he's got to ask you and the market, us, does that really hurt? And think about it this way. So what I think he's focused on is financial conditions. That's my view. So think about the Goldman Sachs Financial Conditions Index, readily available. An index over 100, this is an index means you're tightening on net, and under 100 means you're net easing. We're still around 99. We got as low as 97. It may not sound like very far, but in a big economy, a little bit of gradual easing can multiply. And same with tightening. I think he's thinking that he's going to keep squeezing us until he can get the Financial Conditions Index to 101. Right? Because what's 101? Why do I say that? That's where Chair Yellen got things in 2015, and she pretty much broke China.
Yeah.
Well, he's going to be like a doctor. He doesn't have a date. He's watching you and I.
So he's waiting to see when the market says, I can't take it anymore, we're done here. So the GS Financial Conditions Index, I do a lot of work on, and it basically follows the ISM. They're basically the same thing. Yep. It's just the inverse of the ISM. And the forward-looking stuff suggests that the rate hikes are coming. The framework I've been using is, I think we've had the largest financial tightening in all history, because when I throw the commodity price rise, the dollar rise, and the rate rise, it's like, okay, that's a lot for people to take and corporations to take. So how tight do you think conditions are outside of that monetary conditions index?
So I think you're making a really, really useful point, because there's not just one way to look at financial conditions. And I guarantee, I just picked the one that's standardized. It just gives you easy baseline in history.
Yeah, it's the market benchmark for this.
I don't think it's necessarily great or not. We have a proprietary ones that Kana, my own macro analyst, who's my Fed watcher, that she has. And they actually have, as part of their equation, the Japanese yen. And the Japanese yen is actually easing. So right now we've had this kind of easing in the market as Governor Kuroda keeps a lid on the JGB at 25 basis points. The yen's sort of given up versus the big dollar, right? And again, it hasn't collapsed or anything. It's a lot weaker. And that to us suggests more lending heading in the U.S. market just because of the way hedging works. So it's not yet so that tightenings happen fully. I agree with you. We've had a big tightening of late. And I think it'll be obvious in 6 months that we probably tightened a lot more than we think we have right now.
Yeah, because those mortgage rates that have just exploded in the last few months haven't really gone through to the housing market, but already you're starting to see the housing market slow pretty quick.
Well, you think about this. Went back and been rereading my history, right? So I picked up and reread Chair Greenspan's The Age of Turbulence, that book in 2004, which I thought very interesting. Just read the last section on the future of income inequality, and he explains it in 2004. He said there's no stuff now. So that was interesting. We go back to Chair Volcker, reading a book by Sherry Cooper, who's Dr. Sherry Cooper, who worked for BMO, so you'll know the Canadians very well. This is back in 2002, and she talks about being a young economist at the Fed in late 1970s, early 80s. And Chair Volcker's problem is, how do you slow housing? Because there's a lot of momentum in housing, and either you have to overshoot on rates or literally cut off liquidity to housing. Those are the two sort of options, because a lot of people have some term to their mortgages, so the impact of the mortgage rates going up is felt with a lag. And that's his problem in 1980. And remember when he jacked rates to 20%. His other alternative was to say nobody can get a line of credit, and that would stop things right now. So that's kind of the yin and yang we have right now in the market right now. If I think about housing, it's a lagged effect because it just takes time for those mortgages to roll over.
Yeah. What are you thinking about inflation going forwards? Because, I mean, obviously that's the big thing here, is if inflation stays high, the Fed are going to keep going, and I guess the bond market will allow them to. What's your kind of future expectation of inflation?
So when I think about the long term, the number one thing that we sort of key on is demographics. And if you look at the U.S. demographics, just a great example, we've never had this many 50-year-olds. We're going to double the number of 60-year-olds in the next 10 years. And that may not sound like a lot, but that's a lot of people who are heading from full-on working at the top of their profession to some form of retirement or working less. And those 50-year-olds and 60-year-olds have all the assets, right? A 20-year-old just out of school, 25-year-old, they don't have any money yet. I have two daughters, just graduate college, they have no money. They will.
It's the bank of dad is the money.
I do help. My wife makes me. but that's the point, that you have this period, right, where we have the upside down 1970s. Think about 1960s and 70s. We had a baby boom going on, not just in the US, but around the world. And we had an average age of our workforce was really young. And that workforce in 1970, they're born for a house, a car, college, their first kid. They had no dough. We had not enough savers and too many borrowers. We've flipped over. So whatever your view is of today, it can't be based on 1970s in my mind.
I wrote exactly the same piece. I've been saying exactly the same thing. This is the inverse of the 70s.
Yeah, this is the 1970s.
That was a demand shock. This is a supply shock.
Correct. I couldn't agree more. And, President Lagarde has been right all along, in my mind, that there's not much she can do for a supply shock, other than just she can crush demand. But at the same time, she's now caught up in the current, this river of expectations, right? But that's why my take on things is I fully expect rates to roll over and come back down at some point in the future. Just because with demographics, you think GDP from your first year university is the number of workers times the output per person. If the number of workers is falling, GDP has a headwind, even if you have some productivity with that. And so we do have a headwind to GDP growth just called demographics. And think about the G10, right? The G10's in population decline. It's not just getting older. There's fewer out there. China, Japan, Germany, Italy, Russia, all in population decline and all pretty secular. Like this is, if you want to have population growth, it's 30 years away. And so the combo of the G10 matters because the G10 at this stage has most of the dough. That's just the way it is, right? And so when I'm looking at the future, I actually see a world that is slower, real growth being slower in the future than it is today in general. And I question whether we can get sustained inflation.
Yeah, and I also look at the relentless rise of technology.
Yeah.
And it's very hard to raise wages over extended periods. And I have an issue with a lot of people talking about, look at the wage rises. A, they're less than inflation right now. But if you think of it in exactly the framework you look at, there's a whole bunch of people out of the workforce, a huge number, who don't get wage rises. So the wage rises are a much smaller part of net total demand.
Yeah.
So
Absolutely.
because these guys don't get it. So I don't think there's a huge net increase in demand. So it can't be inflationary.
Yeah, I'm not actually worried about a wage cost spiral. To me, that doesn't really compute into the future, partly because of just the great technology change. And you know what happens? If you have to pay someone more, company management teams are always trying to reorganize to find a way to do it cheaper and faster with fewer workers. And think about this: as those 55-year-olds leave the workforce, they're paid the most. The 25-year-old's brand new. The 50-year-old has been there 20 years. They're paid more just because they've been there a long time. As they leave, even if you give a raise to the 25-year-old, you're still saving money versus the 55-year-old. And I would also say, if you think back to the 1970s, that changed a lot of things. If you go back to the 1970s, and you think about how we were paid, we had a more unionized world, less unionized state. But in the 1970s, we tried wage and price controls, right? If you remember that, not hard, but enough to change how management is. So let's say you have a hotshot young person, it's 1975, you want to give them a 10% raise, but you're told you can only do 6% in the first year, 5% in the second year. But if she quits and goes across the street to your competitor, the competitor can start her at any wage they want. So you have to do something because you're going to lose your hotshot, but you can only pay 6 and 5, but the competitor can pay whatever. So you say, how about I give you a bonus? And the bonus calculation's there. Here's the problem with the bonus or wages. When you're paid on a wage, a base, and a bonus, the base is the thing that gets 5% more a year, 6% more a year. A lot of the bonuses are fixed and not always achieved. And so this is also a big part of things, especially from the cohort of older folks in the system. They're not just wage-based because the unionization's gone down. So they're more base and bonus. And so it's going to be really hard to sustain, is my point.
So there's a few people I respect who are more, it sounds like you are at the same time to me, you're kind of a disinflationist and think that the general channel of rates continues, even though we're right at the top of that 10-year channel, the 10-year yields, I call it the chart of truth because it works every time. But a lot of good friends of mine think that everything's structurally changed. They think the underinvestment in the commodity market and deglobalization and the rise of fiscal stimulus and the big green spending budgets has structurally changed things. My argument is, well, we didn't generate inflation in the 40s and 50s. Why do we now? How are you thinking through the risk of your view being wrong that something has changed?
Well, I'm highly likely to be wrong in some, either a little or a lot. So I'm comfortable with that. But the good news is when you're investing, you can build in flexibility to your portfolios so you can handle that. I look at what's sort of happening. Think about the Russia-Ukraine war. It's acting to us like an exogenous commodity shock.
Yeah.
We already had the supply shock, and we had an exogenous commodity shock. That does affect things. We know commodity shocks usually change the price level for a while, but it decays away, and generally the price level doesn't long-term change. It does in short term, but it does usually degrade economic growth. Exogenous commodity shocks. So we have that right now going on, and it's nowhere more evident if you're in Germany. You're trying to figure out, what am I going to do to get oil and gas, if not from Russia, where, right? And so that will be a factor for a while. But then you start going, well, then base effects start hitting. At some point, you do get demand destruction if you move oil and gas prices up and off. Not yet, but you do get some degradation there. You get some productivity enhancement. And when I look longer term, I think we'll find a way through this. I don't know exactly how the channel will be. And so I'm sympathetic to the point that inflation will stay at elevated levels versus the 2% we got used to for a while. But my sense is we're going to sort of head down to inflation from above, sort of, and get closer to it from above over time, and then we'll see if there's any other exogenous shocks, because there's always something going on in this world.
Yeah, always. Let's talk, before we go back to kind of portfolio and how you're thinking about stuff, let's talk a little bit about Japan. Fascinating, because they're buying, they're printing money into a inflationary phase, which is always the issue with yield curve control. And it's the outlet seems to be the yen, as you said before. can they continue and they just keep doing this until this whole inflationary pulse dies away and people stop trying to sell JGBs at 25 bips? Or do they just give up and we get a sudden, like the Aussies did, we suddenly get a massive move in yields? How are you thinking through Japan? Because I always love these big macro setups like this. They're always interesting.
I agree. So when I think through Japan, I think that Governor Kuroda is definitely on the hot seat. So he's 1 year away from retirement. And you know, he's older. I think his health is not what he wants it to be. So you should expect that in somewhere in the next 6 to 8 months, we're going to talk about the Bank of Japan and the governor. We do have I think it's the upper house elections coming up in the summer. There's a chance for the LDP to win and then get 3 years of peace. So whatever you're thinking about Governor Kuroda and YCC, he probably doesn't change anything till the fall, right? He waits to see because it just makes sense. And then in the fall, if the LDP has the House in 3 years, then the Prime Minister and so forth can decide, you know, who they want the next governor to be, and then what policies and how different they may. So you're going to have the next 3 or 4 months some pretty calm BOJ policy. Okay, so wait till the elections are over, and that's summertime, and you'll have a lot more information. I will say this: Japan has a massive trade surplus, massive current account surplus. Japan can keep this policy until the cows come home, right? Because they're net sellers of U.S. dollars at all terms. They're not in a current account deficit. So think about the peso crisis in the 1990s when Mexico was living above its means, and so it had a current account deficit. It was vulnerable and it got caught. By the way, Mexico today has a current account surplus, so it's actually a banker to the world, which is kind of interesting, right? How's that for a change in 30 years? But Bank of Japan has this current account surplus, which gives them, they're a lender to the world. They're the banker to the world. And so they matter.
And they're the world savings capital as well. I mean, they've got more savings than anybody else on earth, I think.
They and the Germans, really. And the Germans sort of hide it through the ECB. But yeah, the Germans are huge savers too, and huge current account surplus, even within the Eurozone. And
so when the yen is depreciating as it is and yield curve control is in place, are you seeing funds going out of Japan and into, let's say, the US Treasury market? Is it slowing the rate of ascent of the Treasury market? What is what are the Japanese doing in this equation? Because it's always important.
Yeah, so great question, because it gets more expensive to hedge. So your interest rate drop starts eating into your gain. So do people go more unhedged, saying, hey, I'm actually going to bet that the yen's going to go up here or something like that. So I'm thinking about from the US. Let me think about the US side.
Yeah.
US investors could well start buying the yen. They may not want to buy out the yield curve, but they could easily start buying the yen, saying 130, 135, and maybe it gets even weaker. At some point, that policy could change when Governor Kuroda leaves, and there could be a big snap. From the Japanese perspective, so far, the Japanese haven't changed very much as sort of lenders to the world. But it's certainly a factor, for sure. And I think the question is, will they do it hedged or unhedged? And we go back and forth when you think about that, because it depends on what your long-term goal is. So I don't think much changes yet. And 135 is not crazy. This isn't crisis levels for the yen. But a big drop to some other number like 150, 160.
Yeah, and it's been a big move, right? It's been a very stable currency. And it's been, I call it the house of pain, because we've all had a go at shorting the yen. We've all had a go at buying the yen, and it's gone nowhere. We've just lost money, all of us.
Well, it's hard to short a current account surplus country. I'd say that's just a hard thing to do in life, and I probably wouldn't recommend it to most people.
Europe. So Europe's a complicated situation now, right? Because they've had to take self-imposed pain, which is, we're not going to import. So we're going to have to deal with higher prices until we can sort out new supply chains for our fuel. And we're going to transition to green energy. So we're going to have to do quite a lot of fiscal and infrastructure spending. So we've created a very structural issue for Europe. But Europe's a very old economy, in terms of population. There's plenty of debt around, so they can't really sustain this. What does Lagarde do here? Are they going to force the EU to try and give handouts to, direct transfer payments, trying to alleviate the pain? What's your playbook here?
So President Lagarde, she was the most consistent that, this is a supply shock and we're not going to raise rates into it. And she's sort of had to do an about face, probably pushed by the Bundesbank and that category. I think she's going to slow walk it if she can. So, the ECB doesn't plan to raise rates until they're done on net purchases. That net purchases don't end until, let's say, midsummer. So the earliest you're going to get a rate hike is, let's say, the end of Q3. And then the question is how many you get. I think if she has a say, it'll be less, not more, right? Because of her long conviction that this is supply shock and will roll away. And I think she also feels that Europe is more vulnerable right now, especially some parts of Europe. Not all, Europe's not one thing, right? It's got different pockets, and some of those pockets, like Italy, have more debt, more leverage. And so Italy's, pain threshold, if you think about Chair Powell being a bad doctor, Italy's pain threshold is at lower rates than maybe Germany's.
Yeah, you've seen those spreads starting to widen again, right? They haven't got to concerning levels, but...
No, so far, not so. And I think it's because the market sees the ECB as very pragmatic. And I think the market, in my personal view, is that Europe should grow slower. It's got too much debt, it's got very high regulation, taxation, and social sort of blockages. And so it's just not as a dynamic economy as, let's say, the US, for instance. And so you wouldn't expect the same outcomes as the US. So it's slower. So Europe's more vulnerable, in my mind, to an old-fashioned stagflation, at least short-term stagflation, going away later. So I don't have a really negative view on Europe, other than it's hard for the ECB to raise rates like the US. And so you'd think the euro has to stay net cheaper than the US dollar.
Yeah. And, the euro's been, it's broken, my Bloomberg, it's broken the 30-year trend, that whole, and it looks like, and I've always had the view that it was probably going to 80 cents or so, and it feels like that's the way it's going to play out. And
now, remember this, though, the ECB as a whole has a current account surplus.
That's right.
So it's still what I call in its own control. It can do what it wants. It doesn't. It's like the yen, the Japanese. They can decide to keep these rates here, and there's nothing we can force them off. This isn't, where George Soros took the British off the ERM ban because the Brits had a current account deficit, right? This isn't that.
No, but it just feels like the euro, FDI into Europe's still diminishing. You just don't get the feeling that capital's coming in and European capital still keeps coming out elsewhere in investment flows, I guess.
Well, I think one of the issues that we should be dealing with, all of us, is that because companies around the world, they're not stupid. They're run by very, very intense and thoughtful people who are very aware of everything we just talked about. Everything that just you and I talked about, the CEOs of every good company. And you should expect that will have an impact on CapEx. That will lead to some CEOs going, what's the IRR? Okay, no projects that have IRRs lower than 15% and a payback period less than 2 years now, right? You can imagine we start high grading the CapEx, if you want to look at it like that, which is to say we do less CapEx into the future. And I think that certainly happens in Europe.
Yeah, and that might be offset by government mandated CapEx for, the greening of the European economy, because they've made it pretty clear they're going to transition. And so I guess there is some CapEx that comes out of that.
Well, you would think, and Germany's got to be at the lead of that, because they've got an energy shortage right now. They shutting off some of the nukes, shutting off some of the coal. It's led them a little bit short power. And if you think about it, when people talk about power, some of the estimates, we're going to double power demand in the world in the next 20 years. Double again. Because, all this online, my nice iPhone and stuff like that is always roaming and always searching and using battery. We're all connected. And if we do double, we've got to get on that. So it's going to be a lot of CapEx. But that could be a great example, right, of where, the company says this will be a high IRR because partly we can get tax credits for this too.
Yeah.
Yeah.
Yeah, exactly right.
Yep.
So, gun to your head, where are we in US rates? My personal bias is I'm looking for the top in yields, and I think we're really close. I've pulled the trigger once already and got that one wrong, but luckily I did it with call options, so it didn't cost me too much money. What do you think?
So can I make the suggestion that I think we are close to the top here, but I think rate rallies are a dead-end street. So even if you call it right, it won't feel great. You're going to go, that's just sort of sat there, because unless we can get some kind of a risk-off crisis story again, you won't get the really big total returns that you're kind of hoping for in that story. Yeah. So I agree with you that we're way better priced today than we've been priced. I personally like bonds more today than any time since like 2015. This is as good a period to start buying bonds at any time, with the caveat that I don't think you should expect a lot of double-digit return. Like, there's probabilities that can happen. There's paths, because the future's uncertain. But I still think those are out of the money paths.
So you're kind of thinking it's a glide path lower in yields as opposed to economy slows, inflation comes off, bonds scream higher.
Or just a sideways for a while, and you clip coupons that are 5, 6, 7% yields, and that feels okay. Because remember, the bond market now, at the current, the ag benchmark, is almost the 100th percentile in the last 10 years. So this is as good a starting point as we've had in the last decade. Doesn't mean it's the perfect one. And it doesn't mean we'll get a 2019 double-digit return, 2020 double-digit return. For those to happen, we had to have a big event. So 2019, the Fed turned tail and cut rates. 2020 with COVID. So this time the Fed, because it may perceive itself to be a little bit behind the curve, it wants to keep credibility. So at least for the next 6 months, or say a few months, there's going to be fog around the Fed's response function, which is to say, even if financial conditions tighten, and let's say this, the three ways that financial conditions can tighten: stock market could draw down 20%, high yield spreads could go 100 wider, or you could get real interest rates up 0.5%. Those three things, some portion of those, could get you to that 101 that's sort of in the back of my mind. And again, that's sort of more of a, put a dart in it. Doesn't mean that number is a great number. That's where the Fed has to almost wait for that, which means it's going to have to suck up some volatility, which means, like, if you think about Q4 of 18, when the market said that hurts, this really hurts, and they changed course in December and cut rates in 319, I don't think that's coming.
You don't think what we're seeing currently is that? Because it looks so much like 2018 right now.
Well, it does. And I think we're not far away. But I think the Fed, because I think they think they're behind, because they're trying to reestablish credibility, again, it is only one person, so I could be wrong in this, Chair Powell. I think he's going to suck it up here and take more.
So therefore, to explain to people, so let's say the NASDAQ was down, let's say 22% in 2018. This time around, it would probably make him blink when it gets below 30%.
Somewhere, it has to be more than what we got in 18. Because remember, this is the challenge. And it may not be the NASDAQ goes down. Maybe it's just real interest rates sell off. And so the 10-year goes to 4%, right? Yeah. Or maybe it's just high yield spreads go 100 or 200 wider. Think about in the year 2000, high yield spreads sort of went from 450 over to 800 over. And that was after the Fed raised rates 6 times. So think that was Chair Greenspan. That was the forgotten hikes, right? Post long-term capital, post Y2K and all the fear there. So I think that's why I think the fog is still with us for a while, not forever. I'm not bearish long-term on rates. It's just in this period here, as the Fed has to build credibility, the ECB seems to be going along a little bit with the river here and the current. You almost have to sort of acknowledge that this is going to be a headwind to getting a robust rallies.
And does the yield curve flatten or weaken? Or does it just stay sideways in this period of kind of we don't know-ness?
Well, the scary part is real interest rates go up and it steepens. And that would just be all losses all the way along for bondholders, right? That'd be 10s and 30-year real rates going up. Inflation-protected bondholders would hate life because that's they're levered to real rates. So it could be that. So it's not obvious to me we get a massive inversion yet, partly because I don't think the Fed's just adopted our market expectations. They're not sort of doing their own thing yet. Although the QE to QT, and they own 30% of 2 big markets, mortgages and tips, could that lead to more sort of daily volatility, sort of more like the 1990s? You think about 1990s, right? We had volatility is kind of twice what it is today. So right now, the 10-year Treasury in the last like 5 years has been like 4.5% vol. Now it's sort of heading towards 7 vol. The bunds, 10-year bunds had like 2 vol last year or so. They're kind of creeping up. And JGB is about a 0 to 1 vol, and they're creeping up a little bit too. So as that vol creeps up, it leads to more outcomes, as you noted in your option strategy, and more things can come into the money. But I would say we just have fog here right now, Raoul. Fog.
High yields, they probably need to go wider, I guess.
Again, this is what the Fed would like to happen, I think. Again, that would get financial conditions tightening. The hard part, right, is you think about the loan market, for instance. You know that new issuance is down 75% year to date. Most companies are well funded. They move their debt maturity walls out. Well, remember, corporate America is not dumb. They're like us, and they want to live, and they want their stock price to go up because this is how they're incented, and they probably get a base and bonus just like you and I. And so they saw a lot of this, and they took advantage of it, and they moved their debt maturity wall out. So you have right now, even for weak companies, you have almost nothing to default to yet. So nothing to precipitate a liquidity crisis. You can still have, and so if you look at the last year or something, just a little factoid, in the old days, Chapter 11, which is restructuring, was 95% of defaults, and 5% were Chapter 7 liquidation. If you look at the last year or so, Chapter 7 liquidations have been the same amount as 11. Generally now, when a company defaults, it's because they're like the buggy maker, the best buggy maker in 1935. It just, that's it. That's just a full liquidation. There's nothing to restructure here. And so high yields got that tailwind right now. And we still have decent earnings. And most companies, if you do a full liquidity analysis and look at their bank lines, they're mostly undrawn. There's liquidity out there. Again, this is the, Chair Volcker, you raise rates and there's a lag. And that's what I would say with high yield. 2022 probably is okay for high yield in terms of defaults. If you're expecting defaults in high yield, you probably, you should probably be thinking 2024 is sort of, that's where that would make sense. That's possible. 2022, it's harder for me to see that.
And also, I feel like the high yield bond market changed in 2020 because of the Fed. They basically, like the ECB said, we're not going to allow insolvency.
Yes. You think about 2020, one of the reasons I was so excited for clients in March 2020 is even when we went home for COVID and things were scary and, none of us could find toilet paper and stuff. Our analysts went online, did great Zoom calls, and we went through every credit in my portfolio, right? And they certified them good for COVID. This will survive COVID. And that gave me a lot of confidence, right? And then my macro team, led by Con and Aditi and Heather and Tom, they said, we know what the Fed's going to do. We know their playbook. We saw it in 2008. And they basically banged. And so we actually had a ring the bell moment. Go buy risk. The NPV of everything's going up in April 2020. Think about today. There's no ring the bell moment. And so if you're trying to buy back duration, and I think, think about where you are. That's what you're trying to do, is find, is there a ring the bell moment? And I can't find one yet. And that's why I call it the fog, right? There's no obvious moment, because I'm with you. I would like to buy duration back. I would like to go get these rates for my clients and go get even more yield in the portfolio. But I'm cautious because I don't have that moment. I talk to my macro.
Does the recession alone do it, or is it not good enough? We need something that changes it.
Oh, recession would do it. Oh, yeah. Yeah, recession would do it. So you should know, I'm not an if I buy back duration, it's just when.
Yeah. So what you're saying is you expect a recession. You expect this to be a normal rate cycle, and normal rate cycles end in recession, I guess. I mean, they very rarely don't. I mean, 1994 was one of the only ones, right? Yeah.
If it's not a recession, it'll be one of those things where, it'll be statistically not a recession. Depending on which sector you're in, it could feel like a recession.
Yeah, because you're already seeing these tech companies laying off workers. That feels like the employment sector is about to change somewhat.
Yeah, I just go back to this whole demographic piece, and when I think about that, this is my personal view, is that real rates should be low. And we've
I
fallen.
think they should. I think they should be negative
Well,
for a long time.
you're not wrong on that. And I have a lot of sympathy for that notion, in the sense that we had real rates. Think about it. So my first job in Government of Canada, we issued a real return bond, right? And the real rate was 4.25%. Can you imagine? Government of Canada issued a 4.25 real rate one. I laugh at that now. And when I talk to my colleagues and I say real rates could go up here, I'm thinking like 1%, not back to 4%. I'm thinking they could get positive 1%. That would be, in my mind, a pretty high real rate for what I think is coming next 5 and 10 years. Because behind all of this is China is slowing so much. It's not the China we grew up with 20 years ago. This is a much more established and a China that has demographic issues of its own, massive amounts of leverage, real estate issues. It's just, that's China, right? So I'm kind of in a slow growth mode next 5 years, but I'm the bond guy.
Yeah, you love slow growth, right? Of course you want it.
I don't trust the bond.
The equity guys want different stuff. But anyway, look, final question for you. How underweight do you think people are in bonds, whether it's the pension system or just the general bond market participants overall? How underweight do you think it is?
Can I give you two sort of stories? And again, I don't have a great percentage number.
No.
We had a meeting with one of our big clients who's in our tactical product. They're a big pension, and they're 110% funded. Okay, it's a U.S. company. And their question to us was, well, we're going to go to 60% bonds. The 60-40 thing? They're not going to go 40 stock to 60 stock. They're going to go to 60% bonds. They said, should we be 70% income? That was their question to me. So that's one. That's what a fully funded pension fund is thinking. Limit your drawdown.
Do they have an old cohort?
Not so much. No, I can give you. They're a big U.S. bank. So think about that. Now, how about this? A big state. I also rent money for. They're well funded now, partly because they got a ton of money was provided by the federal government in the last couple of years. So this has been a windfall. And then the asset price gains have been extraordinary. And a lot of those states were heavily loaded on equities, right? And that worked. And so now they've been pulling back. So there's a lot of reasons for people to increase their leverage to bonds. Just especially if you think you're fully funded, and even 55 and 65-year-olds, the whole worry about 60-40 and the bonds going away. If interest rates stay at these kind of levels, 5-6% you can get in investment grade companies, there's an awful lot of folks who can say that works for me, or I want dividend companies because I can get preferreds at 8%. You know what I mean? So I would not be surprised that the longer this persists with rates staying here, right, and even inflation a little bit higher, it starts to send people to the bond market, not away from it.
Yeah, interesting.
Yeah,
Jeff, look, fascinating conversation. Really enjoyed it. We'll see how it plays out. I too think there's still a bit of fog around, and I think it resolves in the summer, but I don't know.
it could.
We'll wait and see. I think the resolution is growth implodes, but we shall see. And inflation with it. I'm keeping my eye on the oil market because the bond market seems to be just trading the oil market right now. So.
Well, one thing I've been telling all my clients is stay as flexible as you can right now. You don't have to have a massive overweight to anything, including bonds, and me. Just be flexible, have liquidity. So if something goes bump in the night, you have an obvious asset allocation.
Yeah, that's right. Because this is a pretty scary market, full stop. And as you said, we're not sure we're anywhere near the end of this yet. So everyone needs to be a little bit light on their feet. Perfect, Jeff. Great to see you, and we'll definitely get you back on at some point.
Thank you very much. I appreciate it.
We hope you enjoyed the video. At Real Vision, we help you understand the complex worlds of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.